I again would like to welcome those attending in person or virtually to ABI's annual meeting. As always, it is a privilege and honor to give a brief presentation on the company's progress over the last 12 months, provide insight into several financial metrics, and conclude with an opportunity to answer any questions you might have. While my comments will be brief relative to the year's accomplishments and financial performance, I'm confident that as you reviewed the annual report package, you gained further insight to not only who we are as a company, but the continued good performance and strength of your company. I know that it may seem repetitive to always review the mission statement, but truly, collectively with our vision statement and core values, the mission makes us who we are as a company and determines how we go about our business each and every day. Actually, the vision statement sets our path, and that is to be a company that focuses on our family, team members, customers, communities, while maximizing shareholder value. Our mission is how we accomplish our vision as a company. And while we modernized the core values over the years, we have never strayed from the original values we embrace, nor swayed from our vision or mission. My desire is that you will agree that our accomplishments and strong performance has been accomplished because of this steadfast approach. As outlined in my letter in the annual report, the theme of this year's communication is all in. We made a strategic decision to ensure that we were all in all we did each and every day for all of our constituents, team members, customers, communities, and you, the shareholder. Later in the presentation, I will elaborate further on each, but for now, let's move to the financial presentation. I'll try to set the stage for this year's financial discussion by giving you a snapshot of several metrics in the financial highlights. I will dive deeper into several of these items. However, as you observed and as portrayed here, 4 of the 5, total assets, loans, deposits, and regulatory capital, are reflecting growth, with year-over-year earnings being down 11% at the holding company level and 9.75% at the bank level. Let's now turn to a deeper discussion of our performance at loans and deposits. The economic environment leading into 2023 and throughout the year continued to put pressure on the balance sheet and income statement. Many financial institutions were seeing weakening loan demand or strategically pulling back on lending due to liquidity constraints. On the deposit side, competition continued being front and center, driving higher deposit costs and increased competition for local deposits. I'm proud to report that we were able to grow both loans and deposits in 2023. Total loans grew approximately $81 million, or 16.05%, and total deposits grew approximately $35 million, or 6.65%. Of the $81 million in the loan growth, commercial represented approximately $31 million, residential and home equity loans $16 million, and the remaining $34 million consumer related, but primarily from our dealer finance department. While loan growth wasn't 100% funded by deposit growth, we were able to offset the difference with Federal Home Loan Bank funding, which is competitively priced, and allowed us to slow margin compression. You will notice that since 2019, total loans have grown approximately $260 million, or 80%, and total deposits are up 59% over the same period. I am especially pleased with this growth given the hand the economy has played us over the last several years, and particularly pleased that 2023's deposit growth was evenly distributed across all regions. To further explain my comments on the economy, I will discuss the difference in U.S. Treasury yield curves. First, we will look at 2020, or the blue curve, and 2021's red curve. with 2022 and 2023's curve lime green and darker green respectively. Excuse me. Clearly, 2020 and 2021 are diametrically different from 2022 and 2023 when the yield curve became inverted. An inverted yield curve reflects a struggling economy and is a potential recession indicator, but it also goes against the traditional financial model. Under a normal model, and in the times of an upward sloping curve as in 2020 and 2021, banks buy on the short end of the curve, lower rates, and reinvest further out the curve with higher rates, with the difference of the investment income and funding costs being net interest income. The rate environment also plays into the consumer mindset when investing, as they opt to invest at the highest rate possible relative to acceptable terms. Given we have experienced the fastest increase in interest rates over the shortest period of time, the yield curve inverted, creating an environment of higher short-term deposit costs relative to short-term rates. Result, downward pressure on net interest income or the margin. This can be seen more clearly by looking at this slide. First, as noted in 2023's net income was down compared to 2022. However, still the second highest year of earning in the company's history. Looking at the net interest margin, we saw a decline from 2019's level to a low of 3.38% in 2021. This decrease is primarily due to timing of reinvestment of the excess deposits acquired in our acquisitions in 2019 and 2021. Day one, we bore the deposit cost with a goal of increased interest income via reinvesting those funds. You will note that during the period while the margin was falling, net income was increasing as we were deploying more earning assets. The strategy was working, as during a normal yield curve scenario, net returns would have remained stable to increasing as noted in 2022's performance. That year, both margin and net income was up over the previous year. However, when the rate environment took its turn in 2022 and 23, margin compression became more an issue and fell to 3.6% at year end. To further complicate matters, inflation placed additional pressure on operating costs. Collectively, salary and benefits and other expenses increased 14.48% in 2023. Salary and benefits comprised 12.62% of the overall increase, which was a result of additional staffing to support the continued growth and a move to ensure that our salaries and benefits remain competitive in the marketplace, a key ingredient to talent retention. Put it all together, one could say a perfect storm of increasing costs and falling yields resulting in downward pressure on net income. This slide will further describe net income relative to RA, or return on assets, and ROE, or return on equity, or how well we provided a return on shareholders' equity, or your collective investment. Clearly, the trends of both ROA and ROE follow the previous discussion on net income. Also, during doing the math, it is clear that over the last several years, more assets have been required to produce similar net incomes. I would like to point out the low point of 2021 and the positive turn in 2022. This was a result of our reinvestment strategy given the interest rate environment we were working with at that time. With the aggressive change in the yield curve and margin pressure, 2023 was negatively impacted in terms of ROA and ROE. However, while the trend line in terms of ROA is negative, ROE is reflecting a positive trend. I'm pleased to report that in addition to a positive trend in ROE, we are reflecting a positive trend in our EPS, or earnings per share. As noted, we earned $6.53 per share in 2023, an increase of $2.46 per share since 2019, or up 60.44%. I was pleased to announce 2023's dividend of $2.43 per common share, but I'm just as pleased with the trend line we are reflecting in dividend payout. Since 2019, dividends have increased 14.62%, and collectively, we have paid out $11.41 in dividends over the same period. Another positive trend, and one of significance, is capital growth. Total regulatory capital, or the dark green bar, has grown from $39 million in 2019 to $55 million because of our financial performance over the years. You will note total capital has fluctuated over the same period. This variance is attributable to the change in market value of our securities portfolio. Available for sale securities, as ours are classified, must be marked to market and has been negatively impacted by changes in market interest rates. The good news is we do not need to liquidate these investments and simply will allow them to mature without suffering a loss. This slide compares Tier 1 capital to regulatory guidelines. As you will note, at year end, we were significantly above both the minimum dark green line and well-capitalized light green line levels. We continue to manage our growth and balance sheet relative to these metrics to ensure sustainable growth while remaining well-capitalized. As I noted earlier, we strategically adopted the all-in concept in 2023. First, let's talk about how it impacts our customers. The competitive environment continues to heighten, and to further set us apart and provide additional service to our customers, we brought on new deposit products and delivery services in 2023. You might see one of our courier vehicles out and about as we are providing door-to-bank banking, or you may see one of our mobile ATMs at an event in your community. While they can be used at fairs, festivals, or large gatherings, we can now provide cash in times of a disaster, as the ATM is also solar-powered. One big change this year was a conversion of our digital banking platform. I will tell you that based upon the lift in utilization, it has been a huge success, an indication that electronic delivery of banking services is desired. We can continue to give back to our communities and making sure we are all in. I am pleased to report that we provided approximately $210,000 in financial support to our communities during the year. Also, our team members truly lived out our mission and core values as it relates to community. Without their dedication, there is no way we could have attended or supported 200 community events. I cannot thank each one of them enough for their unselfish support, and I know the community appreciates it as well. One particular element of community support is our partnership with WVU Tech. Originating in 2023, we recently consummated a 5-year partnership with the school as being their premier sponsor of Communiversity. As Dr. Stewart described it during our first visit, the community is the university, and the university is the community. By working together, both can grow and succeed. This concept resonated with me, and I jumped at the opportunity to live out what a community bank is all about. I'm confident that this partnership will pave the way for continued growth in our southern West Virginia market and beyond. Next, all in for our team members. During the year, we migrated from Team Member of the Month to a recognition that tied directly to our strategic initiative. By tying the recognition of all in, we can recognize team members for their contribution to our success. I would like to again recognize the quarterly recipients and Nicole Marsh from our Franklin Financial Center for being 2023's all-in team member. You know, it's one thing to believe in yourself and that you are accomplishing the desired result. It is another when an unrelated source recognizes you for your accomplishments. PCB was recognized by several sources in their BEST campaign, such as West Virginia Living's Best Bank Award and Daily News Record Best Bank and Best Company to Work For, to name a couple. I'm confident that these recognitions are directly attributable to our intentional focus on being all in for our customers, communities, and team members. Well, what about you, our shareholders? As we look at our performance over the last 5 years, you've experienced 11.43% increase in the last reported year-end market price, book value up 9.54%, and a 14.62% increase in the cash dividend declared. I'm confident that building upon customers, communities, and team members, we have been all in for you, the shareholder, and I trust you agree. I'm also confident that the foundation that we laid in the previous years positions us well for the future when we return to a more normal yield curve and operating environment. In closing, this slide says it all. It has been a privilege to serve as your President and CEO in 2023. I look forward to the future, and as we collectively work to be all in, I know more success will follow. I thank you for the continued trust and support you have placed in us, for without you, last year's success would not have been possible. Thank you.